Hey, what's up guys? It's Edward with Crypto University. We've got another delightful video for you. Today we're going to be talking about the exponential moving averages and how we can use them to plot entries and exits in our charts. So let's go ahead and pull up the indicator here. So we'll go ahead and type the script in here. As you can see, I've got it on my favorites right here. EMA cross by D Mark 165. And you can also use the moving average exponential. However, you're just going to have to put it on more than once. So this will only show you one input. The EMA cross will actually show you multiple inputs without having to put on multiple indicators. But I'm still going to put this one on twice as opposed to putting this one on 4 times. So let's go ahead and take a look at this. And I'll show you how to put your inputs, or how to set the inputs. So first of all, we're going to need to change the color coding. Now you can do this to whatever you like. I'm going to put EMA 1 to red, EMA 2 to green. Now the cross here, I'll show you, I'll leave it on for a second so that you can see what it looks like. We'll show you when they cross along the bottom. So for the first input lines, you can use whatever you like. I'm going to use 9 and 26. So basically what these inputs are, we'll take the information over the past 9 days and give you the moving average of it, right? And the exponential is just a more smooth version of it. So this will take information from the past 9 days worth of data and give you the average price that people paid over that time period. Same for this, it will take the data over the past 26 days and provide you with an exponential moving average, or the average price that was paid based off the last 26 days worth of price action. So I'm going to leave the source to close, as it will take from the candlestick close. Now I'm going to go ahead and go to my next one. So this one I will put for 50 and 100. So this is going to be over the past 50 and 100 days of information. Then I will go to the style. Now I'll change this to blue. So my 50 EMA is going to be blue. My 100 EMA is going to be yellow. So you might want to change your crosses here. Actually, let me just take these off real quick so I can show you. I'm going to remove them for the 50 and the 100. And as you can see down here, so here basically you can just see where your EMAs cross, and that will help you to be more profitable in your trading. And we'll talk about how the EMA crosses work here in a second. But that input will show them down here along the bottom. So now to delete those from my first one, because I prefer to find them with my eyes instead of having that clog up the bottom of my screen. And now for the final EMA, see how you only have one input here as opposed to we have 2 inputs on the other ones. So it's the same thing. It's just going to provide you with one input only. So you could stack this up 5 times if you wanted to, but some people are using free versions of TradingView, so we're just going to try and make it possible so everyone can take advantage of all the EMAs even without having a paid TradingView account. So we'll go ahead and put 200 here, and that's going to give us the average price paid over the last 200 days. And you can choose any color you want. I'm going to go ahead and choose orange. So that's going to be the color scheme for this plot. And I'll go ahead and back up now to explain to you a little bit about how this works. So basically, whenever you see that the EMAs are standing very tall and apart from each other like this, you have an uptrend. This is an area of strong upwards price action, and you have an uptrend. So we will talk about the uptrend, the downtrend, and the consolidation. So you can tell again that this is in an uptrend because of all the upwards facing EMAs, right? Using this information here on the screen, we can see that the EMA on an uptrend will use the 9 EMA, or the first input here, whatever you choose first. Now preferably you should look to go between 7 to 10 to keep it between the past 7 to 10 days worth of information. I'm going to talk about it from a 9, 26, 50, 100, and 200 perspective. A lot of people use 50 and 100 and 200. The smaller ones need to be determined by you, but that's what I'm going to be using in this video. So as we surf, the 9 EMA price comes up and touches it, bounces up, and as you can see here, when it strays far away from the EMA, then you can see that it must come back to the EMA. So at some point when it gets too far, it will come back. So you can find better buying opportunities in an uptrend along the 9 EMA. So right here, even in one candlestick, this means that price traveled up this high and was rejected. So when price was far away from here, was a time to short back down to the EMA if you wanted to counter trend trade. But I always say to trade with the trend. So if you would have bought a long position here, you can see that this is the open of the previous candle. Here is the close of the previous candle. So when this candle opened up, it was right along the EMA. That was a perfect buying opportunity as displayed by the strong uptrend that we were in. So you could have rode this wick all the way up to the top, and when it started to fall back down, you could have taken your profits and escaped the trade, knowing that price is going to come back to the EMA eventually. And it did, just in a few candlesticks after, in which point it touched the EMA again, jumped back up and strayed far away. Here's the take profit range. So as you can see, using this, you will be able to surf the EMA. That's called the trend surf strategy. You see here, whenever price falls through the 9 EMA, it will usually use the 26 EMA and then sometimes the 50 EMA as dynamic support. So the first line of support is along the 9 EMA. And whenever you're starting to see price fall back down towards it, you have to be careful that it does not cross under. When you look in this scenario, price shot all the way down to the 50 EMA. So this was a great buying opportunity if you were watching and you were able to buy this dip here, because you know it was touching a support point that it had to come back to the median of the 9 EMA, right? It would be 22% up. So as you can see, the first time that it snaps below the 9 EMA, it usually falls down quite a distance before it comes back over. So if it's being used as support, it will eventually snap back to the median line, and it will, if it falls through, it will eventually snap back to the median line. Now in some cases it will fall further through and continue to go down. We'll look at those in a little bit. But in most scenarios, when it comes down, it snaps back up, and then it will later diminish in trend, and we'll look at some of those scenarios over here. So as you can see, this is a trend reversal by the EMA indicator. So along all this time, we have a strong uptrend, and now price is surfing the 9 EMA all the way up, so it continues a strong uptrend. If it dips down below, that's a prime buying opportunity. You can see here that the EMAs are still on top of and supporting each other in an upwards fashion, so this would still technically be considered a valid uptrend. So if you're able to pay attention during this 4-hour time frame and see this dip pass all the way down through 50 EMA, you could have reliably bought at 50 EMA after it broke through the 9 EMA. See here, it breaks through 9, comes to 26. That's a pretty reliable buy as it strayed far away from the 9 EMA on an uptrend. So here it's on an uptrend. The EMA falls very far down, so it's a pretty reasonable buy, especially if it shot through the 50 EMA. You wouldn't have been wrong buying at the 50 EMA, you just would have had to wait your trade because you know that it must snap back. And in the candlestick it did 11% if you use the 50 EMA, and if you did not use the 50 EMA and you just tried to chase it all the way down to the 100, you could have made 17% on the pullback. So now as you see, it crashes through and it used the 26 EMA a couple times prior to this, so it's obviously losing strength. Now when the candlesticks actually flip the EMA, the 9 EMA, your first EMA line, it will treat it as resistance. So you can see here it's testing as resistance now, and you actually have a cross in your EMA indicator. So at this point you can see once it flipped, sure, it came back, but now it's being tested as resistance. So you do have your snap back to the center line, and it tests as resistance. Now you have a cross. So this is indicative of a short-term downtrend. That means you're going to be looking for lower highs and lower lows to come. Price jumps back over the EMA and travels on top for a short time and uses it as support, but eventually comes back underneath and now is using the 26 EMA as a resistance line as well as the 9 EMA. So now you see that your first two EMA lines have crossed each other. So this is indicative of a trend reversal. So whenever the EMAs cross, it's indicative of a trend reversal. You can see here it failed to claim support and these lines crossed once again. So that is a sign of a downtrend. As you later develop and your 26 crosses your 50, that is a indicator that the trend is getting stronger. The downtrend is getting stronger. So now you're using 3 lines of resistance, right? And as each EMA crosses each other, it makes the downtrend stronger. So here you can see the 50 crosses the 100, and now we're very far away, right? Here we were using the 50 EMA as support, and price was riding along it. Price does not do that for often. So whenever it's around the 50 EMA and even the 100 EMA, you're looking at trouble. You can see here it drops below the 50 EMA and comes straight down to the 100 EMA, uses it as resistance as well as the 9, uses the 100 as resistance as well as the 9. So then it falls below the 200 EMA, and we're looking at a great opportunity to short now. If we haven't shorted this coin yet, now we can see that here, whenever the EMA is crossed this far down the line, we can take a short reasonably low until we start to see some more trend reversal signals. So moving forward now, you can see that the candlesticks flip resistance here and become support. It uses the 9 EMA support now, and it runs into the 50 as resistance, bounces back through its own price channel, comes up, touches both the 100 and 200, and confirms resistance. So that means we're headed back down. And as you can see, price cruises along the 9 EMA now in a downtrend fashion before it comes to flip. So now we're looking at a tight consolidation range as the lines constantly cross each other and don't show any strong or clear trend, because the 200 supports downtrend, yet the smaller time frame supports uptrend. So this is an area of price convergence, and currently we would be looking to test these next candlesticks along the 9 EMA. If it stays above, then we can consider it an uptrend until it runs back into these areas of resistance. So we'll backtrack some data now, and you can see what it looks like. So here's an area of a short-term downtrend because the 9 has crossed the 26. It uses the 9 as resistance until it will come again and flip as support, runs into resistance here, comes down, uses the 9 as resistance, flips to come support. So the 9 EMA is pretty much the heartbeat of your trend line, and it will track through other layers of support and resistance, and this can be considered dynamic support and resistance along with your trend lines. So if you have a trend line in any of these areas and you see that it's also touching EMAs as support or resistance, you can feel better about taking a position at that time. It's best to trade in an environment where the EMAs are very wide and apart from each other. That is where you will have the most success, whether it be in an uptrend or a downtrend. As you can see, there's plenty of opportunity here to be forgiven. And this isn't so much of a strong uptrend here. And as you can see, we've been on a uptrend for the 4-hour chart for quite some time. So here's an area of a strong downtrend that I could find. As you can see, the EMAs cross over one another. Here you have the 100 EMA cross the 200 EMA. So you can very obviously see a downtrend in this scenario, and price comes back up over the 9 EMA again, continuing to come back to that line where it has strayed far from, right? Because when the price strays far away from the 9 EMA, it must eventually snap back. That is also true of every other EMA line. So the farther it gets away from it, the better your opportunity is to get in on a winning trade, as price must eventually snap back to this line. Same as you see it over here, price must eventually snap back to these lines at some point. So I hope that video helped you understand the exponential moving averages and how you can use them to plot entries and exits.